Oil prices edged down on Monday but remained at 4-month highs after top producers Russia and Saudi Arabia extended supply cuts. Global benchmark Brent traded at around $86 per barrel, while US West Texas Intermediate hovered close to $83 per barrel. Both measures capped their 6th weekly gain last week, the longest winning streak since January 2022, amid tightening supplies. On Thursday, Riyadh extended its voluntary production cut of 1 million barrels per day for another month, adding that it could be extended or deepened further in a bid to shore up prices. The kingdom's state oil company Aramco reported a near 38% drop in second quarter profits to $30 billion, reflecting weaker prices. The world's second largest producer, Russia, also announced it would cut oil exports by 300,000 barrels per day in September. Let's get more on this now with Han Tan in Abu Dhabi. He's Chief Market Analyst at Xfinity Group. Han, thank you for joining us again this morning. Are these production cuts sparking fresh fears that oil prices could rise to $100 per barrel again? What's your outlook for the rest of this year?
Yeah, so I think that $100 a barrel is possible, but only if China's economic recovery can really get back on track, right? For example, just to underscore the turmoils that we're seeing in the world's second largest economy and also the world's largest net importer of oil, this week, China is expected to post an outright deflation. All right, which only, again, shows the economic troubles in stark contrast with the persistent inflation in other countries, right? So if China's recovery continues to disappoint going into 2024, then I think $100 oil might be a step too far, with Brent perhaps in the 90s being the likelier price range.
Right, I want to ask you about Saudi Arabia now. Are they likely to continue to slash output given the almost 40% decline in Aramco's profits?
Yeah, so I think it's possible, and given that based on some forecasts, Riyadh would prefer oil to be at $100 a barrel in order to fund its ambitious fiscal spending plans, right? But therein also lies a double-edged sword in the sense that, on one hand, yes, Saudi Arabia has shown the willingness and ability to go at it alone, but at the same time, there are limits to this in the sense that lower oil produced by way of an output cut also means perhaps less income for government spending and slower growth for the economy. So in short, I believe that, yes, Saudi Arabia may trigger more output cuts, but not much more. Otherwise, it risks derailing its fiscal plans for the long term.
Right, Han Tan there in Abu Dhabi. Thank you for your insights. Now to other top stories from around the world. Staying in Saudi Arabia, the country's sovereign wealth fund has reported a $15.6 billion loss in 2022 after the value of its investments were hit by a market downturn. Investments in SoftBank Vision Fund fell, as well as other tech ventures. Last month, the investment fund reported a loss of $11 billion due to tumbling global stock prices and rising operational expenses. Indonesia's economy has grown more than expected in the second quarter, thanks to strong consumer spending during the Islamic holy month of Ramadan. GDP rose 5.17% from the same period last year, up from a 5% expansion in the first 3 months of 2023. But analysts expect economic activity to slow in the second half of the year due to falling prices for its leading export commodities. And Germany's industrial production has contracted for a second month in June, increasing the risk that the Eurozone will face a recession in the coming months. Output declined 1.5% compared to the same month last year, worse than what analysts had expected. The contraction was mainly driven by the automotive industry and the construction sector.